Welcome back, everyone, to Market Wrap. I'm Mo Ansari, and right next to me in my studio today is Mr. Alan Tonelson. He's founder of public policy blog RealityChek. Mr. Tonelson has written and lectured extensively on trade and manufacturing. His articles have appeared in the New York Times, the Washington Post, Bloomberg View, and a number of other publications. He's also, you see him on CNBC, CNN, and you've heard him here for the last 5, 6, 7 years right here on Market Wrap. Alan, welcome to the studio and welcome back to Market Wrap.
Wonderful to be here with you and wonderful to be in Southern California.
Well, thank you for taking the time to stop by today. It's always wonderful to see you. Let's get to the economics.
Sure.
Where are we now and where are we headed? That's what I really want to talk about today. We got the numbers yesterday from the ISM that showed that U.S. manufacturing activity grew at the slowest pace in nearly 2.5 years. But today we got the JOLTS report, which showed that the jobs are going down. Is the economy really slowing, or are we getting some indication the economy is growing in certain parts and slowing in others?
Well, certainly we have a very big and very diverse U.S. economy, and certainly different sectors of that economy are going to be responding to different domestic events, different global events at very different paces. I think overall, it does seem pretty clear that the economy's growth has been slowing down, but it's still growing. So, for example, that manufacturing survey that you cited, it still showed growth. There was, however, a second manufacturing survey that comes out the exact same day. It also comes out each month from S&P Global, and that showed a slight slowdown in U.S. manufacturing from its performance the previous month. And that's just one example of the kinds of conflicting indicators that keep coming across either from private research firms, from sources of U.S. government data. I found it very strange that you had this big reduction in job openings in this morning's JOLTS report from the Labor Department, down from about 11 million to about 10 million. But 10 million is still a greatly elevated number. So I think we're still in this sort of stop-start phase of the post-COVID economy. Lots of things still need to be shaken out, and we might be in this phase for a few more months, but I do detect a secular undertow that is slowing growth down, and I certainly wouldn't rule out the prospect of a recession sometime next year if the Federal Reserve stays on its current tightening course.
That's you said, if the Federal Reserve stays on that tight. But the Fed has come out, and Mr. Powell has said repeatedly, he is going to continue to raise interest rates until the economy slows, until we get inflation back under control. And he's looking 2% for the PCE, which is long ways from there where we are. So he's saying another 125 basis points by the end of this year. They've set a target of about 4.5% for the Fed fund rate for next year. Do you think if we go there, first of all, do you think the Fed is going to stick to that interest rate policy and raise interest rates another 75 in November, another 50 in December?
I wouldn't be surprised if those two sets of rate hikes didn't come through, but I think it's really pretty mysterious as to what comes after that. And I say that for two main reasons. One, if you read the so-called the Fed's reading of where the economy is and where it's likely to go, a collective judgment of all of the members of the Federal Open Markets Committee, you see there was something of a split. There were some who thought the economy was still going to grow faster, some thought it was going to grow more slowly, and there was a fairly substantial disagreement about where interest rates would be. But the second reason that I think there's really not much clarity for the next year or so is that I still strongly doubt that the Fed is going to want to be held responsible for tipping the economy into a recession that may last into an election year. That would be a very controversial move. The Fed is supposed to be, of course, insulated from political pressures, but that's never been the case, or certainly rarely been the case. And I think there's still a pretty substantial burden of proof on those who think that Chair Powell and his colleagues will follow through all the way.
So you think that the Fed is going to back off and they're going to do what they did in London or England, where they said they're going to cut taxes, they're going to do all of this, the interest rates spiked, and then they say, wait a minute, we're going to do quantitative easing. Everybody said, wait, You put a stimulus in on one end, rates go up, then they're going to raise interest rates, the Bank of England raised, and then they say they're going to do quantitative easing. Nobody knew exactly. And then on Monday, yesterday, they came out and said they're going to not do the tax cuts, or at least reduce them. So do you think the Fed will make a U-turn just like they did in England?
I don't think it'll be a U-turn that's that dramatic, but I do think it'll be important to look at the text of the various announcements made by the Federal Open Markets Committee going forward to try to detect hints that they might be having second thoughts. And although Chair Powell has, I think, rightly emphasized the need for more clarity in Fed statements as opposed to the Alan Greenspan days when he was purposely Delphic, as folks like to describe him, I do think that he's going to be increasingly convinced of the benefits of more subtlety. Because again, you don't want the kinds of dramatic U-turns that the authorities in the United Kingdom just exercised, because that would really collapse confidence in the American central bank. And I don't think anybody wants to see that, frankly.
You've been really outspoken about inflation and your belief that inflation has not peaked yet. And how much further do you think it will rise before it does peak, or have we already seen the peak in inflation?
I don't think we've seen peak inflation, mainly because the last report that we saw that told us where that personal consumption's expenditure indicator stands, that's the Fed's preferred measure of inflation as opposed to the consumer price index, on a month-to-month basis that actually accelerated. And the core accelerated, which of course excludes food prices, it excludes energy prices. So in fact, we've seen that again, on that month-to-month basis, inflation just sped up. But also, we just found out that the OPEC oil cartel is talking about reducing production because they're worried that oil prices have been dropping too quickly because the world economy is definitely slowing. There are still questions about the U.S. economy, but clearly the global economy is in much worse shape. A European recession is virtually certain. China has slowed down dramatically. China's a major user of fossil fuels of all kinds. So if the oil cartel acts to cut production, to keep prices up, it's very difficult to see how we're going to get further oil price reductions.
So if oil prices do not come down, and shelter is another problem that we see in inflation that is feeding into inflation, and once people raise rents, they don't increase rents the next month. That's usually very sticky. So you think because of some of those reasons, but shouldn't we put more pressure on the Middle Eastern countries, like Saudi Arabia, like some of the other oil producers in the Middle East, where we are the guarantors of their security, where we are providing their security. We are the ones who prop them up and keep them in power. And on the other hand, they're doing things that are sort of helping Putin rather than the United States. Don't we have any leverage on these countries, especially Saudi Arabia, that we should tell them, look, it's time that you give back or help us right now, because oil prices are definitely contributing to inflation, which is a problem here in the Western world.
Well, certainly in terms of pure power politics, the United States does have considerable leverage with those Middle Eastern oil producers that hasn't been used. But when you bring the economic considerations into the picture, I'm not entirely sure how smart that would be, precisely because there have been so many excesses in the economy, not only during the pandemic, but before, that had been building up. It's very difficult for me to see how you bring those excesses under control without substantially slower growth, and unfortunately more pain for the economy overall, including for U.S. workers, who I think are going to have to experience higher unemployment rates. And I certainly don't want to see that, but there is, I think, a lot of truth into the notion that that the only way to prevent the economy from overheating further is to cool it down pretty dramatically.
So you think that a recession is coming. So are we going into recession? Is it going to be deep recession or mild recession?
I think a lot of that will depend on how tight the Fed keeps monetary policy. And I think certainly the course of interest rates is still quite open to doubt. What we haven't heard very much about, though, is the Fed's quantitative tightening program, where they're no longer buying more bonds and mortgage-backed securities and things like that to keep pumping more money into the system. They're actually selling them now. So that's got a major contractionary effect. Nobody's talking about that, and the Fed has not provided any hints whatever, aside from the usual caveat that it's going to be data dependent, that course is going to be even slowed anytime soon. Now, the Fed's balance sheet is still ginormous,
right,
by orders of magnitude, but it's coming down, and it's important to understand that more stimulus is no longer being put into the economy. It's being taken out.
So you think the $95 billion that they're taking out every month now, basically, because they're letting those bonds roll off and not replacing them, so that's about $1 trillion a year. Do you think that, which no one's talking about, that is in essence also raising interest rates or tightening monetary policy, which is just like raising interest rates, similar to it? We don't know exactly because we've never really done this in history.
Right. And what further complicates the picture is that these monetary policy moves do not affect actual economic activity for many, many months. I keep on hearing that it could take anywhere from 1 year to 18 months for their full effect to become apparent. Now, it's true that when businessmen read headlines that the Fed's tightening, and when they see interest rates going up on those parts of the yield curve that the Fed does not control directly, I'm certain that they start to think and behave more cautiously, and that does contribute to economic slowing. But again, the pace is going to be so gradual. This economy is so enormous. It's like turning around the proverbial supertanker. It's really going to take a while, unless the Fed decides we have no choice but to go full Volcker, to jack up interest rates tremendously and basically conclude they have no choice but to engineer a very deep, extremely painful recession in order to get the economy back to some semblance of normality on a longer-term basis.
We're talking to Mr. Alan Tonelson. He's founder of public policy blog RealityChek. Alan, as always, great to talk to you. What are your expectations for the economy between now for the next quarter, last quarter of this year, and for 2023?
As far as I can see into the future, and it's frankly not that far, I see stagflation. I see lower growth. Although, again, talking about conflicting economic indicators, we just got a prediction from the Atlanta Federal Reserve Bank that says the third quarter growth is going to be much, much better than even they had thought only 3 weeks ago.
Right.
So again, very difficult to forecast, but I do see stagflation. I do see inflation remaining well above the Fed's target rate, uncomfortably high.
Even with the Fed
Americans
raising rates at the rate they are?
Yeah, I do. No one knows what's going to happen with China, whether they'll go zero COVID again to snag global supply chains. There are so many unknowns, moving parts. But I do see the sum of their effects being stagflation, which is not the end of the economic world, but it's not very good, and I don't see how the United States gets out of that particular situation.
Alan, as always, thank you so much for taking time to be with us today in the studio right here in Newport Beach and taking the time to share your thoughts with us.
We've got to do this more often.
We should. You should. Southern California is a wonderful place to visit, and you should come by here more often. It's always great to have you. Everyone stay right where you are. I'm going to take a short break. You are listening to Market Wrap. I'm Mo Ansari, and I will be right back.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.